Welcome to Dare, the show for innovators, entrepreneurs, and startup leaders who dare to shape the future. Your hosts today are Ned Hayes and Cecilia Mariani. Dare is brought to you by Darwaf, the superpower tech team that can make your vision a reality. The Dare Show is excited to welcome Peter Buss to the show today. Peter is a founder of a boutique CPA firm here in Portland that makes a huge difference for tech and life sciences companies. He's the guy that you want on your side if you're going through a merger or acquisition or tax issues or even going public. So welcome to the show, Peter.
Thank you, Ned. It's great to be here with you today and speak to your audience.
Well, so we serve an audience of a lot of tech companies and a lot of startup people who are really interested in taking their business to the next level. So I'll just ask you, as the guy with the numbers, what do we have to watch out for as we start a business going? What kind of questions would you ask as the finance guy in the room?
Sure. I think very early on, a lot of the decisions around entity type and making sure you've selected the right entity that matches what your long-term goals are as a startup.
Right. So tell me more about entity types. What different kinds of entities would you recommend?
Sure.
Yeah.
So more typically in kind of your privately held world of business, flow-throughs are really what's used predominantly, LLCs, S corporations, entities of that type. Really in the tech world and the life science world, to the extent that, we envision there being future institutional investment, really what we see is C corporations. And there are some mistakes that can be made very early on with entities where people choose to go other routes and ultimately potentially disqualify some tax benefits that they would have been able to get had they gone straight with a C corporation from the get-go. And the reason that decision is so important is because there's a provision called Section 1202, qualified small business stock, that potentially allows, with all the right criteria being met, a significant portion, if not all, of the gain on an exit being effectively tax-free. Whereas if you choose some of these other entity forms at the beginning, while there may be some benefits flowing through some losses, for instance, on initial investment, things of that nature, that those benefits often pale in comparison to the potential benefit of going straight with the C corporation, which is where, again, if you're going to get funding, it's highly likely where you're going to end up anyway. And it just adds extra steps and complexities.
So basically thinking long-term or short-term, it sounds like, right?
That's right. Thinking short-term, of course, who wouldn't want extra tax deductions? But the reality is those oftentimes very small benefits in that initial period are just far outweighed by the long-term benefit of going straight with a C corporation, sticking with that structure and meeting all the qualifications to get that exclusion long-term.
Right. So you've worked both with companies that are privately funded as well as ones that have private equity and venture-backed companies. And so you see all sorts of different animals out there, right?
That's right. It's really all over the board. I would say the majority of the entities that we work with at KBF do intend to take on some form of institutional investment, whether that be kind of significant angel, VC, and ultimately private equity or public.
Got it. And so you are also a founder. 20 years ago, you were one of three co-founders of KBF. And prior to that, you were at Ernst Young. So you kind of left a really comfortable slot at a major company to found a company. What led you to do that with your co-founders?
Always wanted to be more entrepreneurial. E&Y was an absolutely great experience. They have great people. Enjoyed my time there, but the ability to jump out and work with companies on more of an intimate basis, helping them earlier in their life cycle than E&Y was able to do just due to overhead and cost structure, was very appealing to us. And so we jumped out to take on that market, and luckily grown from 3 people, which is what we originally started with, to about 185 people today.
Oh, that's fantastic. So you've really grown the company from 3 people to nearly 200 people then.
Yeah, it's been a really fun run, to be honest. A lot of great companies we've been able to work with, a lot of transactions, both buy and sell side. And I've personally done about 25 IPOs over that period.
Wow, that must be really cool to take a company to the point of kind of launching an IPO. Can you walk us through what that process looks like? When an entrepreneur approaches you and says, "Hey, we're at this level, our board wants us to IPO," what do you say to that CEO? How do you make that successful?
Yeah, the IPO process is honestly daunting. It's typically a multi-year process. The vast majority of the clients we work with exit either to PE or to strategic. But again, once or twice a year over the years, we've had a company get to the point where it made sense to go to public markets. And, it's really a whole team. I'm personally a federal tax person. My responsibility is around the federal tax disclosure portion of SEC filings. That's what we work with almost 200 public companies providing that service and a lot of those IPO runs. We also have a group that does advisory work within our firm. They'll help draft, move through technical accounting issues. Oftentimes, as you make a run for an IPO, there's M&A involved and just, there's just a lot of moving parts as you move to an IPO. And we have a team that's been built to essentially get that process done.
Wow. So it's a daunting process. And when you go through this process, you must follow a standard kind of template of things that you want to make sure are covered, things that you're making sure that risk is averted. Can you tell us about some of the things that you keep in mind as you approach that?
Sure, sure. Just in the way a private company or even a venture-backed / private equity-owned company is slightly different than the standard you would expect a public company to work at. So a lot of what we do is coming in, putting in, kind of helping put in the robust infrastructure, the controls, the documentation, making sure that we're, as clean as you can possibly be to get out on a public offering. And so
So,
there's just a
wait,
whole lot of legwork.
pause just a second there because this may be obvious to some people, but why don't we spell it out? Why do you have to be as clean as necessary?
Yeah, I mean, everything at that point's disclosed, right? You have an obligation to your public company shareholders to operate in that fashion. You have essentially SEC requirements. You're typically audited by a large, if not big four firm, where that's just where the expectation is. The formality of audit committees and the robustness of that whole process really just requires you to operate at that level.
Right, right. It kind of reminds me of, I remember I was working at Adobe years ago, and senior VP had me present to a customer, and we had some issues with the product. It didn't go well. And I afterwards grabbed the senior VP and I said, "Hey, I'm sorry that demo didn't go well. We'll get it together for next time." And he said, "Oh, I'm not worried about the customer here. I'm worried about our shareholders. I have to go talk to my bosses." And that was the moment that it crystallized for me that he had, 600,000 bosses out there who owned a share of Adobe that he had to report to. So when you go public, you're actually creating a reporting structure that all those people own a piece of you and they want to have clarity, they want to have transparency, and they want to ensure that their money is being well spent.
That's right. And yeah, just the level of compliance is just so significantly different. The requirement on reporting is significantly different, even from a very large private equity owned company to a public company. You just need far more robust infrastructure than you would otherwise. And so, a lot of companies simply aren't ready for that when they're moving towards an IPO. And it's a matter of putting all the pieces in place to make that a successful offering.
Yeah. So can you share with us some of the names of companies that you've helped with IPOs? I know it's a team and I know the company is successful in its own regard, but I think you can take credit for some of the work that went into it. So what are some of those companies?
Sure, sure. So just a couple like ZoomInfo, we assisted with that initial public offering. While this is outside of tech, we assisted with the Dutch Brothers IPO recently in the
Oh,
last
that's
couple of
great. That's,
years.
that's also one based in the Pacific Northwest.
That's right. That's right. iCore was an example of one that we assisted with. Really, there's just been a bunch over the years. But, there certainly have not been 25 IPOs in the Pacific Northwest in the period in which, we've been in this market. So, some of our IPOs have been in Seattle, some in the Bay Area, some in Southern California, even one in Arizona. So we're not really geographically confined. Our firm is largely West Coast, but even with that said, some of our largest clients are also on the East Coast.
Yeah. So are there any characteristics of companies in the Pacific Northwest that you find different than working with companies on the East Coast or elsewhere?
Honestly, the companies in the Pacific Northwest, and particularly Portland, have to be just a little bit scrappier, is what I find. There's just isn't quite the same level of external funding that we see in other markets, particularly in life sciences. A lot of life science companies in Portland are operating off of grants, whereas we have a very robust life sciences practice out of San Diego, and they're operating out of tens, if not hundreds of millions of dollars of VC money that they've effectively raised. So they just, you just have to be a lot scrappier. They tend to be a little bit later stage before they go get funding here. So, it's a little more personal to the founders as well, I think.
So that's interesting. Scrappier. Do you feel like that's a result of being out here or being removed from kind of the centers of capital, or do you think it's just part of the culture here?
I think it's a little bit of both. I think the capital certainly drives a lot of that, though. The fact that they just don't have the luxury of having, raise 10, 20, 30, 40 million dollars and have the ability to build out teams instantly. There's a lot more thought that goes into a lot of the clients we work with in Portland because they realize they have to, preserve run rate and they need to make just tighter financial decisions.
Fascinating. That's really interesting. So, can you walk us through what it was like to take ZoomInfo public? Because this guy, the founder, he started it like in his dorm room, right? I mean, I think that's the founding story.
That's my understanding. We came into that one pretty late in the game, and our involvement was very specific to the tax portion of that particular transaction. I'm a great company, been wildly successful. He's been very successful personally. They were building out their team internally as well at the time and brought in a really top-notch team, and it's become very impressive.
Yeah. And then you've also been able to help companies with mergers and acquisitions, right?
That's right. We do a lot just due to the nature of our clientele being venture backed and private equity owned. We do a lot of both sell side and buy side M&A.
Yeah. So, what does that look like when we're talking about an acquisition? Are you helping companies to understand their valuation or understand what the offer means to them in terms of the founders who are selling off their baby? Or what does that look like in terms of like actual real feet on the ground work?
Sure, sure. We don't really get into the valuation portion. That typically is more executive group, more bankers. They're kind of addressing that piece of it. For us, with these sort of a couple hundred basically venture backed tech companies, and the very first conversation I have with them is that, we're really not in the tax minimization game. Of course, we don't want to pay extra taxes. We'll do what we can to keep that from happening. But really, what our firm does and what the reason people hire us is to be diligence ready so that when you get to the point where you get that dream offer or getting close to that dream offer and you're going to go through a process to sell and you're going to go through diligence, what we don't want are surprises, that result in things like holdbacks, escrows. And so, we spend a lot of time with our companies that we work with. In fact, we pretty much require all the companies we work with to meet with us a couple times a year outside of the tax return and tax provision process to go over business, to go through a diligence checklist to make sure that there's simply no surprises, or I kind of jokingly say, blood in the water as you're going into those transactions. I find that you don't get discounts, you don't get holdbacks typically if you know where the exposures potentially are and you can put a box around the size of those. Everyone just notes that, understands, and we move on. Where things become problematic is when the diligence team on the other side, oftentimes, honestly, from one of the big four, starts asking questions and everyone has blank looks on their face. And they've never even
That's not
heard of this
good.
before. It hasn't been addressed. And that's what we want to make sure doesn't happen. And so that's why we have a very, rigid formal structure that we go through to make sure we've already kind of pre-diligenced before we get there.
Right, right. So you can have a common understanding, right?
That's right. And jokingly again, I always tell the founders, like, I'm not trying to turn you into a tax person. That's my job. But I have these conversations with them, tell them, what they ought to be potentially thinking about today, 6 months from now, 2 years from now, so that when these issues do come up, they remember and they call and we have the dialogue and we address things real time. That's really the goal of this structure.
Wow. Okay. Got it. So a lot of what you do is building a clear line of communication around the numbers with founders and making sure that they understand their responsibilities and that they are able to report accurately to their shareholders or to people acquiring them, like providing a story in the numbers that makes sense, right?
That's right. And it just goes a long ways when you go into a diligence process and the other side can tell that you have, your ducks in a row, you have things lined up, you've thought things through, and you can just move right through the process without having major hiccups.
Yeah, so if I can ask you a question, if you could indulge me, could you tell me, with maybe without revealing names, about any wacky situations you've seen or hiccups that you've experienced where maybe you didn't expect to walk into a goat rodeo and then you discovered you were in one?
Sure, sure. So yeah, this was years ago, and I bring it up to clients all the time and explain why we are as rigid as we are. We walked into a company, software company, very late. They were really already going into diligence when we showed up. Typically, we want to be there years before that to make sure that we have everything lined up, and
Right.
it's hard to make all that happen instantly. But we came in very late. They needed some help. We walked in, and it was a sales tax issue, and sales taxes, if not number one or number two almost every time in the software world in terms of where there's exposures and where there's probably some non-compliance. It's just very pervasive across the industry. And we walked in, and this was because it was quite a while ago. Physical presence back then is what was needed to create a nexus, the filing obligation, collection obligation in multiple states. And they simply didn't have the data. They didn't have data where their salespeople were going, how often they went to different states, what they were doing there. And so we simply couldn't quantify in a reasonable way how much potential exposure they had. And this exposure went back, 5 to 8 years, depending on the state. And it became big dollars. And it was already, unfortunately, not the greatest round. They didn't get the pricing they wanted. It was kind of a disappointing exit. And then for them to be told that not only that they were going to have to hold back millions of dollars in escrow to basically cover the risk on the buyer side of all this non-compliance in the sales tax world. It just wasn't necessary. If they had known up front that they needed to be tracking this, we could have gone back and at least recreated and probably knocked that number down. But when you simply don't have the records, you're in a tough spot.
Right, right. If you don't plan in advance, right?
That's right.
So, in terms of the work that you've done for tech companies, I'm curious if you could speak to any specific concerns around SaaS modeling, because, and for those who, just as a reminder, that's software as a service where you typically charge a monthly, sometimes weekly or annual subscription fee where people will pay for ongoing usage of online software. So, any considerations there that people should keep in mind if they're starting a company here or if they want their company to be successful as a SaaS company?
Yeah, I mean, and the things we try to identify early on are places where you can have real cash exposure. So the very first one, and this again, people tend to try and push the edge on this, founders early on, is around employee classification. We
Mhm.
try and tell all of our clients when we come on immediately, if they're employees and they don't meet the definition of an independent contractor, get them onto payroll as quickly as you possibly can. That's where executives can get personal liability. Companies, it adds up very quickly in that space. We see a lot in the equity space, people not documenting things correctly up front, not getting valuations that need to happen to stay compliant. That's an area we have a lot of focus on up front. And then again, back to sales tax. That is for SaaS companies. That is probably the number one area of exposure as they start to scale, become multi-state, whether they're creating a physical nexus somewhere or the economic nexus that came out of the Wayfair case at the Supreme Court that catches a lot of companies by surprise.
Right, right. So getting people like you involved early helps there not to be surprises. As I've known throughout my career, typically surprises are not a good thing.
That's right. I mean, surprises aren't great, and tax surprises, I think, are even frowned on them. It's just aggravating to everyone involved. And so, being on the front end of that, it costs a lot more to unwind mistakes than it does to get out in front of it.
Right, right. So having you on their side might be really helpful to avoid those negative surprises. Got it. So, since we're talking about surprises, have you had any surprises in this business that have been positive? Things that maybe you didn't expect when you got into this 20 years ago that you've learned?
Yeah, I mean, I think working with entrepreneurs, especially, and that's why I do spend quite a bit of my time working with kind of the early stage. I certainly work with a number of public companies, a lot of larger private equity owned. But I think maybe the most positive experience that I have day to day is working with the earlier stage entrepreneurs who, I always joke, people ask, what's your ideal client? And I simply say, well, look, I'm looking for people that are going to try and take over the world and go try and do exciting things and use their imagination and build whole companies around those concepts. That to me has been the biggest surprise. I suppose maybe I didn't think about when I was in college that would be something that I would gravitate towards. And I just truly enjoyed that experience.
Oh, that's great. And since you've worked so closely with many of these companies, do you continue to stay in touch with them, track their progress, help them with ongoing tax and revenue issues every year?
That's right. I mean, usually once we are engaged, it's fairly rare that we don't go the distance to a liquidity event, particularly on the tax side where I am in an advisory group. So many of these are very long-term, relationships, anywhere from a few years to 15 years, especially with public companies that tend to be less transactional in nature. So yeah, we're very involved long term, and the Portland and really the tech ecosystem period, and as well as life science, tends just to churn a lot. So it's a small ecosystem. And so what we find is CFOs and tax directors and controllers will move from company to company, and they tend to bring us along with them. And so oftentimes, even if the company has changed, we'll have very, very long-term relationships with the C-suite.
Yeah, that's fantastic. So you are a reliable long-term partner who stays with the company for years, then it sounds like.
Yeah, that's certainly the goal.
Yeah. Well, this has been a really instructive conversation for us and for our audience of startup leaders who need to have reliable people like you in their corner. I'm curious, Peter, if you could tell me, as a founder of KBF and as a long-term participant in the startup ecosystem, what do you dare to dream?
I guess for me, it's just being involved, again, well, externally anyway, being involved with more of these entrepreneurs. I would love at some point in my career to basically get in with a company from the very day one and go all the way to an IPO. Oftentimes, my IPOs, I get involved more when they're at kind of the PE level and they're a little bit more mature. I would love to go the distance with one. I have a few clients right now that I was able to get in very early, and I think there's a chance that they may be able to get to that point. So I'm excited about that. And then internally, again, we've gone from 3 people to 185 people. We continue to grow at a very rapid pace and build out our teams. And I very much enjoy building out professionals in my accounting world and, making partners and making KBF a household name in the tech space.
That's great. Well, thank you for your time, Peter. I really appreciate the insight that you provided. And for all those companies out there that are thinking about IPOs or mergers and acquisitions, Peter Buss and the KBF team stand ready to help you. There's a plug for you, Peter.
Thank you very much.
Okay. Thanks to our guests today for their great insights on Dare, the podcast for innovators, entrepreneurs, and startup leaders. If you'd like your story to be featured on Dare, just contact us at info@darwaft.com. Dare is brought to you by Darwaft, the tech team that can make your vision a reality.